It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, the employment situation. November jobs report from the Bureau of Labor Statistics is due out on December 8th, and after job growth slowed markedly in October, we'll be closely watching to see if the trend of generally lower monthly job gains continued in November. As you can see in this chart, the number of new jobs added month to month continues to trend lower. What's more, the unemployment rate has risen 0.5% off its post-pandemic low of 3.4% that was reached in January of this year, which coincided with a 54-year low in the measure. Now, the U.S. unemployment rate stands at 3.9%. To be clear, an unemployment rate of 3.9% alone is not concerning, as the average unemployment rate over the last 10 years is approximately 5%. However, the 0.5% increase in the unemployment rate over the last 6 months is the largest 6-month increase that the U.S. economy has experienced since November 2009, excluding the pandemic. Economists estimate 175,000 jobs were added to the economy in November, which would be much improved from the previous month, but job gains are sure to hold below the trailing 12-month average of 243,000. We'll also be watching to see breadth of gains within the November report. Last month, just 3 sectors, healthcare, government, and leisure and hospitality, accounted for nearly all the job gains, leaving the rest of the overall economy with no net job growth. This contrasts with the more broad-based hiring seen earlier this year. Finally, we'll be looking to see if wage gains continue to ease as the Federal Reserve aims to get wages back closer to its inflation target of 2%. Number 2, the final Fed meeting of the year. The Federal Open Market Committee will conclude its final policy meeting of 2023 on December 13th, and given that the committee is almost certain to leave its policy rate unchanged, we'll be more anticipating the commentary that accompanies any change in the policy rate or lack thereof. It's increasingly likely that the post-pandemic tightening cycle has reached its peak, despite the U.S. economy re-accelerating in the second half of 2023. Chairman Powell has repeatedly reminded markets of the Federal Reserve's commitment to achieve a 2% inflation rate, despite many market pundits suggesting this will take a considerable increase in unemployment, i.e. a recession, to achieve this goal. Despite Chairman Powell's comments, the rates market has largely been betting that the Fed would cut rates aggressively in the not-too-distant future. This, however, has changed since the Fed's September meeting, and now much of the recent change in interest rates has stemmed not from expectations for a higher terminal Fed funds rate. Instead, the expectation now is that the Fed will hold rates at these much higher levels further into the future. Number 3, Santa Claus Rally coming. U.S. stocks rallied into the Thanksgiving holiday, with the S&P 500 gaining 8.1% in the month leading up to Thanksgiving, its best stretch since 1999, and there's reason to believe that the rally could continue into year-end, that is, if we can get a Santa Claus rally. Since 1950, the S&P 500 has risen 70% of the time from Thanksgiving through New Year's Eve for an average gain of 1.7%, hence the term Santa Claus Rally. With the Fed having been on pause since July when it last raised its benchmark interest rate, market sentiment has shifted. 6 months ago, the consensus among economists surveyed by the Wall Street Journal was that the economy would enter a recession over the next 12 months. In October's survey, the average forecast of economists was for no recession. Now, the market too seems to be fully pricing in a soft landing. While we're hopeful that stocks can continue to march higher into the year-end, the recent rally has stocks once again looking expensive, with the price-to-earnings multiple on the S&P 500 nearing 21 times, and macroeconomic data that suggests that risks to the downside remain plentiful. Whether you're a believer in the Santa Claus rally or not, seasonal indicators have proven useful in a year where volatility sources ranged from new Middle Eastern wars to a U.S. regional banking crisis. If the seasonality holds, we've made it past the worst stretch of the calendar year. And that's been your Market Minute for the month of December. Thanks for listening.